Good evening, students. Welcome to our live classes on the subject of GST. We are in a very interesting topic of GST, the soul of GST, that is input tax credit. Today, we will revise whatever we have done till now, and then we will proceed further with our further deliberation, and then we will complete this and go to some practical questions.
सर गुड
Yes,
इवनिंग।
yes, beta.
सर अपना ने क्या 5th पॉइंट से बाकी है ना सर, ब्लॉक क्रेडिट लिस्ट में
बड़ा तो मैंने
रिवर्सल।
अभी कुछ बोला, आपने सुना नहीं शायद। मैंने अभी क्या कहा, आपने सुना? यस बेटा, मैंने अभी कुछ कहा, आपने सुना?
आपने कहा कि रिवाइज करेंगे जहाँ से
एग्जैक्टली
आप
exactly. तो रिवाइज तो फिर स्टार्टिंग से करूँ ना कि फिफ्थ से करूँ? रिवाइज बोलो कैसे
स्टार्टिंग से
करें,
सर
बोलो।
मतलब।
ठीक है ना?
यस सर।
यस स्टूडेंट्स, सो वेरी गुड इवनिंग एवरीवन। यस, गुड इवनिंग श्रीधर, अंकिता, वैष्णवी, everyone who is present here. So let us start. So this is the Atma of GST. Why? If you remember, I had explained in the very first class that what is input tax credit. So credit for the time being, you can take it as benefit. What is the benefit? When you purchase something, either goods or service, so let us call it as input side of your business. So whatever you have done on the input side of the business, while purchasing that, while procuring that, your supplier from whom you are procuring those goods or services will definitely charge GST on that transaction. Now, when the supplier is charging GST on that transaction and you are paying that GST and purchasing it, that GST paid by you to your supplier is called as your input tax. So firstly, we are understanding it conceptually, then we'll also see the technical definition part. So conceptually, input tax is nothing but the tax paid on the input side of your business. Correct? So this is the input side of your business. Now on your input side, you have goods and services. Services are called as input services, and goods, if capitalized in books, will be called as capital goods. If not capitalized, charged to your P&L, it will be called as inputs. Now on any of these, while procuring them, whatever GST tax you have paid, when I say GST, it means CGST, SGST, IGST, UTGST, or GST paid under forward charge, GST paid under reverse charge. So whatever GST tax is paid on your inputs, this is your input tax. Now this input tax is allowed to be adjusted from your output tax liability. So when you are computing your tax payable to the government, you can set off, you can subtract, you can knock off the tax which you have paid on the input side of your business. Correct? This is the benefit. So what is the benefit? Let us say your output tax is 50, but on the input side you have already paid 25. So that 25 is subtracted. You have to only pay the balance 25. Similarly, if your output tax is 25 and on the input side you have already paid 10, so you can subtract this 10. So effectively you have to pay only 15. So this adjustment, this deduction, this setting off of your input tax from your output tax is possible only when you comply with some conditions, some requirements of the law, so that this input tax is your input tax credit. So basically, input tax credit is the input tax which has satisfied all the conditions and passed through all the restrictions so that it becomes eligible to be set off. So when you set it off, that is the true benefit that you are getting. And that is why it is called as input tax credit. I hope this is clear and understood by all. Now, not every input tax becomes input tax credit. Why? Because there are some conditions attached. There are some restrictions put. Only when you satisfy the conditions and you cross all the restrictions, then only your input tax is called as input tax credit. That is, it is now available to be adjusted, to be subtracted from your output tax. That is what is the difference between input tax and input tax credit. Now, there are two steps in this, you can say, chapter or concept. Step one is whenever you pay any input tax on your purchases, on your procurements, you have to check whether their conditions are satisfied or not. If the answer is yes, you have satisfied the conditions, then you can show that input tax in your books as your benefit or input tax credit. So step one is availing the credit. That is, whatever input taxes are levied on your purchase side, on your input side of business, you show them in your books as your input tax benefit, that is input tax credit. Now, once you have done this is step one, which is called as availing the credit. That is obviously how it will be availed, only after satisfying the conditions and restrictions. Then will come step two. What is step two? Once you have identified that, yes, for all these input taxes, I have satisfied the conditions for all these input taxes have now become my input tax credits. Now you will knock it off. You will adjust it from your output tax. Now this will happen only once in a month, because only once in a month you pay your output tax when you file your return, that is, you file your 3B returns. So whenever you are filing your 3B returns, at the time of filing the returns, you will knock off, you will set off the input tax from the output tax. This step is called as the utilization of the input tax credit. Correct? Now in this chapter, we see definitions, we study the conditions, we study restrictions, and we have some special situations. Now, conditions are given in section 16, which are in two parts. Correct? Now, if you remember, section 16.1 deals with the eligibility. And only two requirements are there for eligibility. One, you should be a registered person. And second, the input services, capital goods are for use in business. So whatever you are procuring, inputs, input services, capital goods, that should be for being used in your business. So this is the
Sir,
eligibility condition. Yes, madam.
sir,
Tell me. But I am not able to listen to you. If you are saying something, I am not able to listen. I only heard sir. Thereafter, I am not able to hear anything. No voice, beta. Yes. Okay. Now, what are the conditions? You should have a proper tax paying document. B, or not B, sorry, have the double A first. Supplier should have reported in his GSTR1 and it should reflect in your GSTR to be. Then the goods or services should have been received by you. Correct? Then the ITC is not restricted under section 38. Supplier should have paid the tax. Correct? You should have filed the return. But if you are saying something, please try to unmute again and say, because last time I could not hear anything. Okay. So students, these are the different conditions that we studied. If you recall this, so 6.1 dealt with eligibility, and then 6.2 had all these multiple conditions. Let us just go through them once again as a revision. So what are the eligibility criterions? 2, 1, you should be a registered person. Second, the goods services should be for being used in your business, that is for the purpose of business. Then third, what are the conditions which are given in section 16 bracket 2? So there are total 6 conditions. First, there should be a proper tax paying document, which is generally the invoice, either given by the supplier, which is in case of forward charge, or invoice raised by you on yourself. You means the recipient on yourself, which is in case of RCM. Then after raising of invoice, if there are any additions in future, it is done by using debit note. In case of imports, it is bill of entry. And wherever your head office wants to distribute the common credits to its departments or units, it uses the invoice, and your head office is called as the input service distributor. Now, these are the minimum requirements that should be mentioned in your invoice so that you are entitled to take the credit. So these are the minimum requirements to be mentioned in invoice. Now this point, which is also there in 17.5, it says that if any tax is paid by reason of fraud, that is after being caught and you are trying to evade tax or trying to fraudulently not pay the tax and you are caught, and thereafter you pay that tax, the recipient will not be eligible to take credit of such tax. Then comes the second condition, which is in clause AA, which says that your supplier should have filed his GSTR1, which is the outward supply return. In this outward supply return, your supplier should have shown his sale invoice, which is your purchase invoice. And on the basis of his GSTR1, it will auto-populate, it will reflect in your purchase return, which is the GSTR 2A or 2B. Yes?
Sir,
Go ahead, beta. Go ahead. I cannot hear you any further. Please continue. But I'm not able to hear anything from you. Ayushi, if you are saying something, I cannot hear you, beta. Yes. No voice, beta, Ayushi. I don't know what is the issue. Ayushi is saying, can you please unmute your mic? My mic is unmuted only, but Ayushi. My mic is never muted. It is continuously unmute. But I think there is some challenge at your end. That is why maybe you're also not able to hear me, and maybe I'm not able to hear you for the same reason. So kindly reconnect, maybe. You can log out and reconnect. This can help maybe. Okay. So what is the second condition in clause AA? That supplier should have filed the outward return, which is GSTR1, so that details reflect in my inward return, which is my GSTR 2A and 2B. And on the basis of this 2A and 2B, I am able to claim the ITC, which is the second condition. Then comes the third condition, which is in clause B. Third condition deals with a simple requirement that the goods or services should have been received. Now, firstly, the requirement is about physical receipt of goods and services. Thereafter, it goes to a specific scenario called as the bill to ship to model. Now, in this bill to ship to model, supplier has billed to you but delivered at some third person's place. Now, in this case, the explanation clarifies that when it is a bill to ship to model, even though you are not physically receiving the goods, but when on your instruction the goods are delivered to a third person, it will be deemed to be received by you. Same thing applies for services in case of bill to ship to transaction. Then comes a clarification by way of a circular. The clarification is that whenever it is X works contract, where you have to pick up the goods from the factory gate of the supplier, then what is the date of the receipt? The date of the receipt is not when the goods physically reach your premises. It shall be the date when the goods are picked up from the premises of the supplier. So that will be considered as deemed to be received. Then the fourth condition is your ITC, which is communicated to you, which appears in your 2B statement. This should not be restricted by section 38. Now we have discussed this section 38 in detail. It was revised also. So I'm not going to each of the pointers of 38 now. So 38 has given various criterion, various situations under which your credit may be restricted or not allowed. However, as I had mentioned, none of these conditions are today applicable. Reason being, this particular section 38 requires all of these conditions to be notified or prescribed in rules. And today, no rules have been notified for any of these conditions. Hence, technically, section 38 today is not applying, but it is there academically because it is part of the law. Next requirement is tax should have been paid. Now, this originally was a very rigid condition, and it has been read down, struck down in multiple court judgments. In all those judgments, the Honorable Court said that this is a very harsh condition. Whether supplier pays it or not is not in your control. Hence, the law amended. They did not remove the 16(2)(c), but they amended it by saying that now 16(2)(c) condition is subject to provisions of 41. And now in section 41, they brought in the concept of self-assessed ITC. What it says, so I have made a purchase from you. Now, I don't know whether you have paid the tax or not, but on the basis of purchases from you, I can take the ITC on self-assessment basis. So I will take the ITC immediately when I purchase the goods and I satisfy all the other conditions, not knowing whether you have paid the tax or not. Now, you are required to pay this particular tax immediately, but if you do not pay it immediately, now this harsh condition of 16(2)(c) has been subdued in section 41. Because of this subdued condition, now even if you have not paid the tax, I will not be required to reverse the ITC immediately. I am given the time up till September of the next year. So after this financial year closes, next year September is the total timeline up till which I will wait for you to deposit the tax. If you deposit the tax up to next year September, Still, this condition is satisfied. I need not reverse. I need not pay any interest. But if you, that is my supplier, has not paid the tax, even up to 30th September of the next financial year, then I am given 2 months time up to 30th November to reverse the ITC, failing which I will have to even pay the interest. Now, this reversal is not permanent. Whenever in future you pay the tax, I can re-avail the ITC. Most important, for this re-availment, there is no time limit. I can re-avail any time in future. There is a time limit, but that is for the first time availment of ITC. So when I'm taking ITC for the first time, there is a time limit under section 16.4. But whenever I'm re-availing ITC, in that case, there is no time limit. It can be re-availed anytime in future. And then the last condition is I should have filed my returns. I means the recipient, means the buyer. Avijit Beda, when you have reversed the ITC with interest, if you are re-availing it in future, interest cannot be re-availed. So interest will always be your cost. Fine, Avijit? Now, some restrictions which are put in section 16. What are these restrictions? Where your goods are delivered to you in different trucks. So that the goods are heavy items, huge items, like I gave example of windmill. Now, I've purchased one windmill, but this one windmill has to be broken into parts and dispatched in 6 trucks. Now, out of 6 trucks, only 4 reach to me, remaining 1 or 2 are yet to reach to me. And let us say 31st March, which is just concluded. I only receive 4 trucks, not all trucks out of 6. Then I will not be able to avail the ITC. This is what this restriction or condition says. You will be able to. This condition says I will be able to avail the ITC only when the last truck reaches me, which they say the last lot is received. In other words, I will put it differently. Only when the entire consignment is received by me, only when the last of the trucks reaches me, I will be able to take the full ITC, not before that. Then there is another restriction. This applies whenever I have purchased the goods or services on credit, that is not by making immediate payment. Now, whenever I purchase on credit, the law puts a condition of 180 days. That is, I should pay to my creditor, to my supplier within 180 days from the date of invoice. So today, when I've made the purchase, I have not made the payment because the purchases are on credit. Today, I purchase the goods or services, and if all the other conditions are satisfied except this, I will take the ITC immediately. Now, this condition has to be satisfied in next 6 months because 180 days is roughly equal to 6 months. If in next 6 months I have paid this outstanding amount to my supplier, this condition is satisfied, nothing doing. But if I do not pay this up to 180 days, then I need to reverse this credit on the 181th day. And if I fail to do that, then I have to even discharge or pay the interest. Now, this amount which I have reversed today is again not a permanent reversal. This I can re-avail in future whenever I pay the amount to my supplier. So again, this is firstly reversing and then re-availing in future. Again, for re-availment, there is no time limit. Now, this condition will not apply in 3 scenarios. First, where the supply is under RCM. 2, where it is a deemed supply which does not require payment because it is a Schedule 1 transaction. And 3, where that part of this supply is added because of the valuation provision under 15.2, which I had paid already to a third party on behalf of supplier. So these are the three scenarios when this restriction of 180 days will not apply. Then comes the most important restriction, that is the time limit. What is the time limit restriction? The time limit restriction says any input tax credit pertaining to any financial year should be availed by me, should be taken in my returns, should be shown as my ITC up to maximum 30th November of the next financial year. So if let us say the purchases of August 25, I should have shown it as ITC in my 3B returns last up to 30th November 2026 or up to the date of filing my annual return, whichever is earlier. Practically, it will always be this 30th November because people prefer to file their returns after 30th November. But if somebody files the annual return before 30th November, let us say on 10th of October, then 10th October becomes your last date for availing any ITC. Now here, if I miss to claim that ITC in my returns, I will permanently lose that ITC. I will never be able to claim that ITC. Then, in relation to this time limit, there is one clarification. Now, this clarification is particularly in relation to RCM. So, I am a recipient of goods or service which is covered under RCM. And in this case, my supplier is an unregistered supplier. Now, what will happen if the supplier is unregistered? The supplier cannot give me a tax invoice because the supplier is unregistered. Now, here in the invoice chapter, you study that the law has required or put a condition on me that I should make a self invoice. That is, I should prepare a tax invoice on myself. So I'm calling it as self invoice because I am preparing it on myself. In such cases, there is a possibility that I prepare this invoice after some period of time. Now, in this particular case, the question is the time limit given under 16.4 has to be applied how? So let us say, for example, the transaction pertains to financial year 24-25, but I have prepared the invoice for this transaction in October 2025. That is very late. So the transaction pertained to financial year 24-25. So let us say March 25, but I prepared the invoice which I had to prepare on myself in October 25. Now, if I take the time limit of 16.4, considering March as the relevant date, then the time limit will be 30th November 25. But the law says 16.4 applies not on the basis of date of transaction, but on the basis of date of this self invoice. Now, since self invoice is raised by me in October 25, so 16.4 will apply considering October 25 as the relevant date. And then the last date for claiming this ITC will be 30th of November 26. And this is the most important point. Wherever you are re-availing any credit, so the credit which you had earlier reversed, now you are re-availing it. Section 16.4 time limit does not apply to such credit. Then there is another relaxation for 16.4 time limit, which is in 16.6. Now, what is this 16.6 time limit? 16.6 time limit applies to a specific scenario where your registration was temporarily cancelled. So you are a registered dealer, but for some reason, your registration was cancelled and it was again reinstated. That is, the cancellation was revoked. In other words, your registration was reinstated, but it was reinstated or restored at a later period of time. Now, whatever is the credit which was applicable for this in between period, that is a date when your registration was cancelled till the date the registration was restored, how will you avail that credit? So the time limit has been given 16.6. It says that after the date of revocation, that is the date when your registration is restored, you are given 30 days from that date to claim all the missed credits of that period. And then after this, we have the restrictions under section 17, 1 and 2 and 75. Let us go to those restrictions. Just allow me a moment. Now, we come to the restrictions or conditions of section 17. Now in 17, there are two parts. First part is 17, 1, 2, 3, 4, and the other part is 17, 5. Now what does 17, 1, 2, 3, 4 deals with? It deals with proportionate reversal of your credit. Now for what reasons your credit will be reversed proportionately, that is not completely, proportionately. There are two reasons. One is 17.1 and the other is 17.2. What are these reasons? First, 17.1 deals with the scenario where part of your input tax credit is used for supplies related to business and part is used for supplies not related to business. So not related to business, you can say, is like your personal consumption. So when you are using your inputs partly for business and partly for non-business, 17.1 is triggered and 17.1 says only whatever is linked or related to use in business, you will take the proportionate credit. Whatever you have used not related to business, you will have to reverse that credit. So the first reason given for proportionate reversal is that the credit is used partly for business, partly for non-business. Second important reason for reversal is given under 17.2. Now 17.2 deals with a scenario where you have multiple goods or services, some of which are taxable and some of which are exempt. So the best example is a grocery shop, a kirana shop. So in a grocery shop, there are multiple items, multiple goods. Some are taxable, some are exempt. Now in this particular case, whenever you are making supplies of taxable goods as well as exempt goods, then again, the proportionate reversal triggers. It says that whatever is your ITC, proportionate ITC related to taxable supplies, that ITC you will avail, and whatever is related to exempt supply, that proportionate ITC you will reverse. So the second reason for doing proportionate reversal is where your outward supply includes taxable as well as exempt. Now coming to the most important part of your this ITC chapter, which is blocked credits. Now what are block credits? Block credits are those input taxes for which the law says we will not allow you credit, or in simple words, the credit for these items is restricted or blocked. Now, what could be the reason for restricting these items? So when you go through the list, you find that it covers those items where there is a possibility of the items being used for personal use. Like, what is restricted? Credit of motor car, expenses relating to motor car. Now, if you study income tax, in the head PGBP, that is profits and gains of business and profession, commonly you get this adjustment that the motor car is used 20% for personal use. Now, this is very common that item like motor car could very conveniently be used by you for business as well as for personal. So wherever the law has found that there is any such scope, any such element that you can use a particular item for both business as well as non-business or personal use, then they have used 17.5 to block it. Yes, if you ask me, I personally believe that this is a very harsh provision. They should not have completely restricted or blocked this credit. However, that is how the law is. Similarly, in 17.5, you find further items like restaurant, catering, beauty services, healthcare services. All these, again, if you observe, has the component of some personal item, some personal use. And that is the reason why the law has felt it in their wisdom correct to completely block this. Though my understanding is slightly different, they should have allowed me proportionate credit here as well, because these items are partly used for personal use, not completely. Hence, they should have allowed me some concession here, but fine. Today the law is like this. Now, first item which is blocked, or the ITC of which is blocked, is ITC on motor vehicles. Aditya says, sir, these personal use are taxable or exempted? They are taxable, na? Because the person who is in business of selling motor vehicle, for him selling motor vehicle is the business. So he or she will charge GST on that motor vehicle to me. When I'm purchasing the motor vehicle, I may use it for my personal use or I may use it for business use or both. So at my end, I may be using it for non-business purposes. This is where they want to restrict it or block it. Fine. Okay. Now, first item which is blocked or the credit of which is blocked is, yes, Aditya, you're right. Healthcare is exempt, but not all items are exempt. Within healthcare also, there are conditions where it may be taxable. So obviously, this question of blocking of ITC will arise only where, firstly, it is taxable. If something is exempt, there is no question of blocking. Correct? So here, when they have given healthcare generically. So wherever healthcare is exempt, there is no question of blocking, because anyways, there will be no GST applicable on that. So there is no ITC question at the start because nobody has charged GST on that. Correct? Okay. Now with relation to motor car, if you remember, I had given you, I think it is written here. Yes, I have given you some shortcut, because if you read this section of motor car, it is slightly confusing by the language of the section, because firstly the section is negatively drafted and then again it gives exception. So it creates slight confusion that what is allowed, what is not allowed. So I have made this simplified version of this. Now what is blocked is given under section 17.5. In this, they are saying motor car is blocked, but then they have given exception where the motor car ITC is also allowed. Now, what are those cases? So firstly, what does this motor vehicle include? So motor vehicle will include two-wheeler, three-wheeler, four-wheeler. Now, when ITC is allowed, you should know this list. Remaining all cases, ITC of motor vehicle is blocked. First, where motor vehicle is your stock in trade because you are in the business of selling motor vehicle. Second, you are in the business of transportation, traveling, tourism, and motor vehicle is used for running this business. Third, you are in the business of imparting motor driving training. So you are running a motor driving school and motor vehicle is used for giving this training. Next, where the motor vehicle is not used for any of above specific reasons. So it is a normal regular use motor vehicle like how I am using for my day-to-day commutation to my office, to my client's place, etc. Now for me, the motor vehicle ITC will be allowed only if the motor vehicle is of a capacity of 13 plus passengers. If it is up to 13 passengers, like all our regular motor vehicles, the credit is blocked. So keep in mind, where you are purchasing a motor vehicle, which includes two-wheeler, three-wheeler, four-wheeler, for being used in your business, the credit is always blocked. It is not allowed. Correct? Next, very important, if you have purchased a goods transport vehicle, credit is always allowed. There is no condition restriction here. Now, 17.5A deals with the credit on purchase of vehicle, and 17.5AB deals with the credit of expenses on the vehicles, expenses like repairs, maintenance, servicing, insurance. So where your purchase of vehicle, in these cases, ITC is allowed. So in these same cases, the expenses like repairs, maintenance, etc., ITC will also be allowed. So simple rule, where the ITC is allowed for purchase of motor car, the ITC for expenses on motor car will also be allowed. Now, similar to motor car, you have another category, which is ships, that is vessels and aircrafts. So many times big businesses purchases personal jets, personal planes for traveling of their directors, for traveling of their MDs, for traveling of their senior employees, managers, etc. Credit is not allowed. Credit for purchase of ships and aircrafts will be allowed, similar to what you studied about in motor vehicle. One, when your business is selling this ships or aircraft. Two, you are in the business of transportation. Three, you are business of providing training. Now one is training of driving the vessels and one is training of flying the aircrafts. And last, it is a goods transportation vessel or aircraft. In all these cases, credit is allowed. In all other cases, the credit is blocked. And then comes the expenses relating to motor car, vessels, etc. So where the motor car is eligible, the expenses are also eligible. Then comes the fourth item. So instead of purchasing, you are taking the car on lease. You are hiring the car. You are taking the car on rent. So instead of purchasing the car, where you take the car on rent or lease, in such cases, what will happen? So in such cases, the rule is again similar. Here in two cases, credit is allowed. One, where the car is same which is covered above. So where in above cases for purchase of car, credit is allowed. In the same cases for hiring of car, the credit will be allowed. So the rule is simple. Where I am giving you credit on purchase of a particular type of car, if that same type of car you are not purchasing, you are taking on rent or hire or lease, I will allow the credit of that rent, hire or lease. Second scenario where the credit of this car will be allowed is the second case when the credit of this car will be allowed is where you are subcontracting. What is subcontracting? You are in the business of the car on rent or lease, and for giving the car on rent or lease, taking the car on rent or lease. So that is, it is a case of subcontracting. In such case also, the credit will be allowed. Just a minute. Now the next list is, now these are again something on the front of personal item. Now what are these items? I have spent on food beverages, outdoor catering, beauty treatment, health services, cosmetic plastic surgery, or life and health insurance. Now, where I have spent on all these items, the credit will not be allowed. This is the rule. However, what are the exceptions? First, again, where it is subcontracting, that is where I am going to provide the same type of service on my outward side. So for providing the same type of service on my outward side, I've purchased these services on my inward side. So something like subcontracting, it is allowed. Second, where as an employer, I have to provide these services to my employees, and providing this is a statutory obligation. That is, it is compulsory under some law. In such cases also, I will be eligible for the credit. Next, wherever I have spent on membership of club or on health or fitness center, again, this credit will be allowed where I have to provide this to my employees under some statutory obligation. Similarly, last, where I have sent my employees on travel and they are on a vacation and I am spending or bearing their cost. In such cases also, the ITC will be allowed to me. Correct? Only when doing so is my statutory obligation. Then comes the next part, that is 17.5C and 17.5D. Now both these clauses 17.5C and D, they deal with construction of immovable property. Now for construction of immovable property, what is the rule? Now whenever there is construction of immovable property, you have to check this first. Is this expenses capitalized in your books or it is treated as revenue? If it is treated as revenue, ITC is always allowed, there is no problem. If it is considered as capital, then is it a plant and machinery? If yes, ITC is always allowed. If it is other asset like building, like any structure, then ITC will be blocked. Now here, if you are a builder or a contractor, that is your outward supply is construction service, then all the above ITC will be allowed to you. So if you have, now what is covered in 17.5C and D? So 17.5C covers where you have hired a works contractor who is going to do construction of some immovable property for you. And 17.5D covers whenever you purchase any types of goods or services and you are using those goods or services for doing some type of construction of immovable property. Now, these credits are always allowed to builders and contractors because their outward service is same. So when you are providing the same category of outward services, the inputs of all these items is allowed. This is the general rule. Correct? Then coming to some more items in 17.5 list. So wherever inward supplies are received by whom? By a NRTP. Who is NRTP? NRTP is a non-resident person who has come to India for a very short period of time. And in that short period of time, the person is going to make some supplies, some outward supplies. So NRTP is not allowed ITC. This is what is the rule. Again, there is one exception. It is allowed ITC only of one item, that is of goods which it had imported. So when NRTP is coming to India, if along with him or her, he is or she is bringing some goods, that is importing some goods to India, only the ITC of that imported goods is allowed. All other ITC is blocked. Next, very important one is whenever you are spending any amount for the purpose of corporate social responsibility, which is your obligation as per section 135 of the Companies Act, still, despite of it being an obligation, this particular expenses ITC is not allowed. Next, wherever you are using the inward supplies for personal use, ITC is blocked. Now again, this section is very important. Wherever you are giving away your goods as gift or giving them away as free samples. So when you are giving it as gift or as free samples, ITC is blocked. Next, if your goods get lost, stolen, destroyed, again in these three cases, you will have to reverse the ITC. And last, if you are writing off the the goods in your books, ITC will again be not allowed. Mek is asking, sir, it means ITC is allowed for purchase of motor vehicle and whatever expenses on motor vehicle, ITC is allowed. Yes, Mek beta. So in the situations which I have listed, like your business is of sale of motor vehicle, or you are in the business of traveling tourism, or you are in the business of uh, running a motor driving school. In these specific cases, you are allowed the ITC for purchase of motor vehicle also, or the ITC on the expenses incurred on the motor vehicle. So both ITC will be allowed, but only in those defined cases, not in any other case. Fine. Then there was a question relating to sales promotion. For this, there is a circular. So this circular is also covered in other chapter because this is a very comprehensive circular addressing many issues of GST. Now in sales promotion, commonly you give samples and free gifts, or there are offers like buy one, get one free, or you have discount schemes where as the person goes on purchasing more, the discount percentage increases. Now, in all these cases, the question is whether ITC will be allowed. Now, whenever you are giving your own goods as gifts or free samples, 17(5)(h) applies and ITC will be blocked. One scenario. Second scenario, if it is covered in Schedule 1, it will be considered as deemed supply, and in that case, you will take ITC, but at the same time, you'll have to pay tax, considering it as deemed supply. Now, in both these cases, that is buy one, get one. So here, you are giving one item free along with other, but the law says we will not consider it as free. We will assume that for a single price, you have given two items. So in such cases, ITC is not blocked. Similarly, where you are giving items in such a manner that the more the person purchases, the more the person is going to get discount or the person is going to save, ITC will not be blocked. Then comes medicines and drugs. So many times for these pharmaceutical or the chemist and the druggist, the challenge is that whatever medicines they are purchasing, they come with an expiry date. Now, if the medicines are expired, the question is, what is the treatment? First rule is if the medicines are expired, ITC has to be reversed. Now, there are different possibilities. First, the chemist or the druggist, that is the retailer, is not allowed to return the goods. In such cases, the ITC will have to be reversed by the dealer. Second possibility, the dealer can return the goods back to the company. In such cases, the company has to reverse the ITC. This is what is the treatment given over here. Next, this point we covered earlier in section 16 condition also. Wherever tax is paid by reason of fraud or in cases of detention, confiscation, ITC of such tax paid is not allowed as credit. Then you come to ITC in special circumstances. Now, what is this special circumstances? So first part of this special circumstances covers the scenario where you are shifting from one category to another. What is this one category? You are unregistered and now you are getting registered. Now it may be compulsory registration, it may be voluntary registration. Now in this case, when you are converting from unregistered to registered, then you have to take stock of inputs, not of capital goods. Only whatever is stock of inputs lying with you, which is not more than 1 year old, now you can take the ITC of all those goods which are lying in stock on the date on which you convert from unregistered to registered. Similarly, where a registered composition dealer converts to a regular dealer, or a registered person who was still now dealing in exempt goods converts to taxable goods. In both these cases, again, you are allowed ITC. Now here you are allowed ITC of both things. One, items which are in your stock as inputs, plus items which are in your stock as capital goods. Only the thing is that for capital goods, you will be allowed proportionate ITC. I hope you remember you have to consider the life of capital goods as 5 years, which is also equal to 60 months. And whatever is the proportionate life for which the goods are already used, you will reduce that much ITC, balance ITC you can avail. Right, students? So this is the first scenario covered in section 18. Then the other scenario which is covered in section 18 is the reverse scenario. So first scenario is when you are converting from unregistered to registered. The second scenario is the reverse of this. What is the reverse of this? So the reverse is you were registered, now you are becoming unregistered, or you are converting from regular to composition, or you are converting from taxable to exempt. Now, in these three scenarios, which is opposite of the first category, now the rule is whatever ITC you had already availed and which is now lying with you in the form of stock. So whatever stock of inputs or of capital goods is lying with you, you have to accumulate the ITC, you have to find out the ITC of that stock, and you have to reverse that ITC. So ITC on inputs, ITC on capital goods, both have to be reversed. Again, for capital goods, you have to do the proportionate working, and only the proportionate ITC has to be reversed. Then comes another scenario where you are selling your capital goods. Now, whenever you are selling your capital goods, you have to pay an amount which is higher of one of the two amounts. What are one of the two amounts? One, again, the proportionate ITC on the balance life, or two, the tax which you calculate on the transaction value of such capital goods. So you have to find two amounts. One, the proportionate ITC on these goods after reducing the ITC for the life for which the goods are already used. And two, for whatever price you have sold these goods, find the tax on the transaction value, that is the sale price. Out of both these amounts, whichever amount is higher, you have to pay that amount. So this is what is the situation. And then comes the last situation which we discussed in the previous class. That is where your business is sold to someone else, or it is getting merged, demerged, so under amalgamation, demerger. So whenever you are transferring your entire business, either by way of sale or merger, demerger, in such cases, if you have any ITC balance in your books, now since you have transferred the whole business, this section 18.3 allows you to transfer the ITC balance also. So whatever is the ITC balance lying with you in your books, you can transfer it to the buyer of the business. Obviously, there is a procedure, there are forms. Following that procedure, you can transfer the ITC. So students, we have completed up to this point in the previous class. If anybody has any queries or doubts on any of these points, you can ask me. Gaurav asked, sir, if not taking ITC when you block the capital asset, then at this side. See, if you're not taking ITC because let us say the capital asset is not eligible for ITC. So at the time of purchase of capital asset, if you have not taken ITC, then out of two amounts, one amount becomes zero. Which amount becomes zero? The amount of proportionate ITC becomes zero, but still the second amount will be there. That is on the sale value. You will still have to compute the tax, right, beta? Now, yes, there is a relaxation given by way of a circular, but since all that is not part of the syllabus, I'm not getting into that. So the simple answer is you will have to pay tax on the sale value. Yes, students. Anybody, any questions or doubts up to this point? No further questions? Great. Just allow me a minute. Okay. Now, since there are no more doubts, Mehak is asking, sir, if registered person switch taxable to exempt. So, beta, we just discussed, na? So, if you are switching from regular to composition or from taxable to exempt or from registered to unregistered, in all these cases, whatever is the stock with you of inputs and of capital goods, for both of these items, you will have to reverse the ITC. On it, stock of inputs, entire ITC has to be reversed. On stock of capital goods, you have to reverse proportionate ITC after reducing the ITC for the period for which you have already used the asset. Right, beta Mehak? Is this understood to you? Yes. Okay. Perfect. Now we go to a very interesting scenario. Again, this deals with transfer of ITC. Now, what is this scenario covered in Rule 41A? Let me explain. Now, what is this scenario? For this, you have to understand one point of registration. Now, registration chapter says that if you have multiple places of business in a same state, so let us say in the state of Maharashtra, I have my office at 4 places. One is Pune, one is Mumbai, one is Nashik, and one is Chhatrapati Sambhaji Nagar. Now, in these 4 places, I have my offices. Now, the registration chapter says that since the state is same, I have two options. Option one, I can have separate registration for these 4, or I can have one single registration for this 4. Now, the answer would be different if these places would have been in different states. If the places would have been in different states, then compulsorily I was required to take separate registration, right? But this rule 41A is not covering that scenario, but that I'm just explaining or adding for your understanding. Now, this 41A applies to the scenario where I have multiple places in one state and I have taken a single registration. Now, understand one thing. What is happening if I have taken single registration? Whatever purchases I am making in each of these offices, for all these, I have a single registration number. It means I have a single ITC ledger. Now, since there is a single ITC ledger, my entire ITC is appearing as a total figure, entire ITC of all the 4 branches combined. So see, I am having purchases in all branches, purchases of imports, capital goods, but everything is commonly in one ITC ledger. Now, today, I decide to take separate registration. Now, what will happen? I am now making these 4 places separate. So this single registration, I am cancelling and taking separate registration for these 4 places. Now what this rule 41A says, whatever is this entire ITC, I'm having entire ITC in one registration. Now I will be dividing this ITC in 4, because now my single registration has become 4 separate registration. See, again, I repeat, if I have multiple place of business in the same state, I am given these 2 options. 1, for all the places I can have single number, or 2, I can have separate number for all the places. I firstly opted for the first option where I took single registration and covered all the 4 places in that single number. And then now, after a few years, I want to split and make it separate. So it is something like demerger in your accounting sense, though not actually demerger, but in your accounting language, we can call it as demerger. Now, what this rule 41A says, this rule 41A says, I will proportionately divide this ITC into all the 4, because this was common ITC for all the 4 in one number. Now, since I have taken 4 separate numbers, I will divide this common ITC into these 4 numbers. Now, for doing this proportionate, I will take a ratio of assets. So what I will do now, when I will separate these 4, I will have to prepare now 4 separate balance sheets, and whatever was this common, now I had again shown all the assets also commonly. Now I'll have to show assets separately in each of these branches. So I will take the ratio of that asset of this is to this is to this is to this, and then whatever is my common ITC, I will divide that ITC in the ratio of asset, and that will give me individual ITC for all these 4 branches. This is what Rule 41A says. I hope this is understood. Correct? Transfer unutilized ITC lying in the credit ledger to any or all of the newly registered places in the ratio of value of assets. Correct? So I will use the ratio of the value of assets of each of these branches, and taking the asset ratio, I will divide the common ITC, so that now ITC will be with all 4. Now Gaurav has a very good question. He said, what if there are no assets? Now see, this is a very rarest of rare scenario. At least there would be some nominal assets like computer, some small furniture item, but let us assume, because we need to understand the law. Now, if the assets are not there at all, zero, then the entire ITC will continue to remain in one registration only. Now, what had happened when I taken single registration, I had shown Pune as my principal place. So what will happen? This original GST number will be given to Pune, and for Maharashtra, Nashik and Chhatrapati Sambhajinagar, I would be given separate numbers. So since the original number, that is this single registration number, will be given to the principal place of business, which is Pune, so the entire ITC then, Gaurav, will be sitting in Pune only. It will now not be divided. Why not divided? Because for dividing, you require the ratio of assets. If, as you said, there are no assets at all, zero assets, then it will not be divided. Then entire ITC will remain with Pune. Correct? Understood, students? Now here we complete the entire step 1. Abhijit is asking what happened when the stock in Pune is maximum. See, firstly, beta, here it is nothing to do with stock. So common ITC, they are saying that you have to divide it in ratio of assets. Asset may include land, building, plant machinery, computer, so many things. So it is not anyways, Abhijit, related only to the stock. So stock may or may not be there in these branches. It may be very high in one of the branches, low in other branches, but that is not the deciding factor. Here, they are asking you to take the ratio of assets only. So in the ratio of assets, you will divide whatever each branch will get, that will be the share of each branch. Correct, Abhijit Beda? Right? Now we come to step 2. Up till now, whatever we were discussing was step 1. What was step 1? How to avail ITC or when to avail ITC. Now comes step 2. How to utilize this ITC. Now, what is utilization? See, utilization, again, I take you back to my original lecture, first lecture, where I showed you this working. Now, this part is utilization. Which part? Where you are subtracting the input tax credit from your output tax. This is utilization. So utilization basically means subtracting or setting off the input tax from your output tax. Correct? So setting off the input tax from output tax is the utilization. Now you will say, sir, what is so special about utilization? So the special point about utilization is, see, as you can see, the section is 49, original section. Then there was 49A, 49B. Then you had rules 86A, 86B. There are multiple points in utilization. So we start with the first part of utilization. Now again, if you remember, I had over here mentioned that you open separate ITC ledgers. ITC ledger of IGST, of CGST, of SGST. Similarly, you also have separate liability ledger. So whatever is your output tax, it will also be IGST, CGST, SGST, correct? Now comes the point on utilization. How is ITC to be utilized? So what is utilization? It is nothing but setting off against output tax liability. Now, what does all these sections, section 49, 49A, B, then rule 86A, all these say? Now, they are saying that you have to utilize the ITC in a proper sequence and in a proper manner. What is this sequence? What is this manner? Let us understand. So I'm showing my output liabilities here, and I'm showing my input tax credit here. So I have output liability of IGST, I have output liability of CGST, I have output liability of my state's SGST. Similarly, in credit also, I will be having credit of this. Now I may have all or I may have one of these. Now what is the rule? The rule is you have to start compulsorily with the input tax credit of IGST. And this has to be compulsorily first set off here. So one means sequence one. So IGST ITC should be first used, and it should be first used to set off IGST liability. Now, after this setting off, let us say you are still having balance of this. So I'll take some example. This liability is 50,000 and this ITC credit is 90,000. Now, for paying this 50,000 liability, you are using your 50,000 credit of IGST, but you had credit of 90,000. Now, after you have used the credit here, which is compulsorily the first in the sequence. So compulsorily you have to start with IGST credit and you have to compulsorily use for IGST liability. This is what all these sections and rules are collectively saying. Now, after paying this, after utilizing this, after setting off here, if you still have balance in your IGST credit, which in my example is, now the law says you can use it for paying off these liabilities. Now let us say these liabilities are 1 lakh. So this is your liability and this is your credit. Now I am having originally 90,000 credit, out of which 50,000 I have used here, and compulsorily I have to use it here only, IGST credit against IGST liability. Now I'm left with 40,000 credit. Now this balance 40,000 credit I have to utilize first. In short, before I start utilizing my CGST or SGST credit, I have to completely exhaust, completely utilize my IGST credit. So firstly, you have to nullify the IGST credit. This is the rule. And for nullifying it, you have to first use it against IGST liability. After doing this, when I'm left with further 40,000. Now, what does the law says? For using this 40,000, I can use entire 40,000 against CGST. This is my option one. Nothing here. Or I can use entire 40,000 here and nothing here. Or I can use this 40,000 in both. So let us say I'm using Acha. Now it is not necessary that you have to use equal in both. You can use 30,000 here, 10,000 here. You can use 15,000 here, 25,000 here. So, but there are different possibilities of using this IGST credit. So the rule is firstly start with IGST credit and firstly use it for paying IGST liability. After that, IGST credit, if it is still balance, you have to utilize it like this. So I'm writing 2 means the second in sequence is this. So you have to use the IGST balance credit for paying off CGST, SGST liability. How you have to pay this? Either full CGST, no SGST, or full SGST, no CGST, or use in both. When you are using in both, it can be used in any ratio, in any proportion. You can use equally, you can use more in CGST, less in SGST. That is your choice. Correct? Is this understood? Is this clear? Any questions with this, students, before I proceed? Good. Now, after I have completely exhausted my IGST credit, now the second in sequence is CGST credit. Now let us say I have the credit of CGST equal to 50,000. And similarly, SGST credit also I have 50,000. Now, for the time being, I am assuming I have opted for this option. That is option 3, where I've utilized the balance 40,000 equally in both. Now, after I have completely utilized my IGST input tax credit, the second in sequence is CGST. So after IGST, I have to compulsorily come to CGST credit. Now this CGST credit, the law says can be utilized here and here, but it cannot be utilized here. This is very important. So what is the condition restriction given? CGST credit can be utilized for IGST, can be utilized for CGST, but it cannot be utilized for SGST. First point. Second point, it has to first be utilized here, then here. Now, in this present example, I have no liability balance here because this entire 50,000 liability was knocked off here. But let us say this would have been 1,50,000. This IGST would have been 1,50,000. So definitely I was not able to utilize my IGST credit completely against IGST liability. Some IGST liability is still balanced. Now, if I'm having IGST liability also and CGST liability also, the rule is CGST credit has to be first used for my CGST liability and then I can use it for IGST liability. So when you come to CGST, first preference is CGST, second preference is IGST. Correct? Now, in my present example, I have 1 lakh as my liability, out of which 20,000 I have used IGST. So I will now use this 50,000 here. See, this is what is the point on utilization, how you utilize your credits. Now for that, first this sequence is important. Then within each, some sequence is given first this, second this. However, when you come to CGST, first this, second this. So these are the sequence which you have to keep in mind. Correct? Yeah. Similarly, now I come to SGST. Again, SGST can be used both for paying IGST and for paying SGST, but not for paying CGST. And again, between this, I have to first use it here. Then only I can use it here. So sequence-wise, SGST credit can be first used for SGST liability and then for IGST liability. Now here, in my case, I have 1 lakh. I had utilized this 20,000. So this balance 50,000 I'm utilizing here. Correct? And this 50,000 I had utilized completely here. So now what is my position? Balance. Now whatever is left, I have to pay through my cash ledger. Now 1 lakh minus 20 minus 50, 30,000. 1 lakh minus 20 minus 50, 30,000. Correct? So this is what is about utilization, students, given in these sections read with rules. Anybody, any questions? Yes, Tanmay.
Good evening, sir.
Good evening, beta. Please tell me.
Sir, you said that it was up to us on how we wanted to distribute the utilization of the balance in IGST.
Correct.
So, on what basis will we decide the amount that we want to utilize for CGST or SGST?
That you will decide on the basis of this. Now, you have some credits in CGST, SGST. You have some
Yes,
liability in CGST, SGST. In this simple
yes, sir.
example, I have taken the liability same and the
Yes, sir.
balances also, credit also same. Now, in sums, as we will go to see the sums, you'll find that these amounts may be less more. So CGST may be less, SGST may be more, correct?
Yes, sir.
Now, if let us say your CGST credit is less and your SGST credit is more, then how you should
Yes,
utilize your IGST? You should utilize your IGST majorly here. Why? Because you have less credit in CGST to use here. Are you getting my point?
yes, sir. Yes, sir.
So that your question is very valid. How you will decide that out of this option 1, 2, 3, which option you should use? So I've used option 3. Why? Because my liability is also equal and my credits are also equal. Equal means same. But where you will find that the credits are plus minus, in that
Yes,
case, you will have to use option 1 or 2. Understood,
sir.
beta?
Yes, sir. Thank you so much, sir.
Perfect, beta. Great. Yes, Aditya.
So good evening, sir.
Good evening, beta. Please tell me.
Sir, if CGST is more, SGST is low, how it shows, sir?
Sorry, beta.
CGST amount is more, SGST amount is less, sir.
Huh.
What should happen, sir?
What should happen of what?
In IGST, sir, CGST amount is more, sir, but SGST amount is less, sir.
But I am not understanding your question. You're only saying something is more, something is less. Now see, there are amounts here also in CNS. There are amounts here also in CNS. Which amount you are talking about is more and less? The amount of
Sir,
CNS liability.
sir, CNS liability in the CGST amount is more, sir.
So better don't say more or
SGST,
less. Give me an amount. See, I have given some amount in my example. Now you give me a revised amount so that I will understand what you are asking.
sir, in CGST amount is
Revised amount.
70,000. Revised amount is 70,000, sir. If assume
Liability.
that
Liability.
liability is 1 lakh, sir.
Then which is 70 here? Credit.
Yes, sir.
That
But a voice is
input
not
tax
audible.
credit
Voice is
amount,
not audible. Voice is not audible.
GST or SGST.
But a voice is not audible. Aditya,
I,
हाँ,
sir, I
sir.
think he,
Sir, in,
sir, I think he's
sir,
telling about input tax credit amount, sir. CGST
okay,
and SG.
okay.
yes, sir.
Tell me, Aditya.
Sir, sir, in IGST amount, if it shows 1 lakh, in 70,000 is CGST, sir.
Hmm.
But in SGST, 30,000, sir.
Okay. Then now what is your question?
The question is, if CGST amount is high, in last question you say that SGST amount is high, CGST amount is low, sir. Low. But my question is, if CGST amount is high, SGST amount is low, sir.
Hmm.
What should be the
Oh, option two.
what?
Option two. So simple, beta. In previous question, I said option one when CGST was high. Now, if SGST is high, you'll go for option two.
Okay, sir. I understood, sir. In option three, sir, what should it depend, sir? Option three.
When it is equal, which is my present example.
Okay, sir. Okay, sir. Thank you, sir.
See, beta, simple is you have to do reverse. Reverse means what? If CGST credit is high, then utilize your IGST balance for SGST liability. If SGST credit is high, utilize your IGST balance for CGST liability. Because whichever balance is high, that balance you can utilize later for that liability. But whatever balance is low, you will utilize IGST over there. So in simple words, whichever balance of credit is low, if CGST is low, utilize IGST in CGST. If SGST balance is low, utilize IGST in SGST. Simple. Whichever balance of credit is low, utilize IGST credit over there. Simple. Anita, let us take some different examples to cover all these scenarios. So that will be much better instead of you all asking me different questions like this. Let us take different scenarios, correct? So I'll give you different scenarios and then you can give me your answers as per your understanding, correct? So one scenario I have covered. Let me take some more scenario. Scenario 2. Okay, I'll do like this.
Sir, sir is speaking on.
I think sir is facing some problem. It's got disconnected.
Any issue, sir? Okay. भार्गव जी, यूट्यूब में 2 मिनट का बैनर कर दीजिए।
In my net. 1 second. So now we'll take a few practical examples to understand whatever I just explained more practically with different possible scenarios in this. So I'm curating few different case scenarios. For each case scenario, you will give me the answer so that you will also understand whether you have understood the concept or not. So you may take down these case scenarios, you may write them down, the figures which I'm writing. Chalo, students. Either you can write it or take a screenshot of this. So these are 5 different case scenarios. I have tried to, one second, sorry. Second case scenario has to be slightly changed. Sorry. Okay, now you can take a screenshot. So 5 different case scenarios given to you. And in these 5 different case scenarios, you have to do the utilization part, correct? Chalo, screenshot done. Yes, students, screenshot done. Say yes or no. Okay. So now I'll just change my screen. I'll show you the sequencing part. So this is what you need to know.
Yeah. Right. Right.
See, I have given you the sequence and I have explained you what to do. Now using this, you have to solve, correct? So you have 10 minutes and I will take my 10 minutes break. Till then, you will solve and then we'll discuss the answers. Fine, students? So I take my 10 minutes break. You have to solve until then. something? Okay, good. Very good. So let's get the answers. Let me solve the first one in this table itself. Chalo. Chalo. Now, what are the first values, students? So 1,250,000, 250. So liability is 1,250,000, 250. ITC balances are 160, 2 lakh, 2 lakh. Now, as a rule, I have to start with IGST credit first, and I have to utilize it from IGST liability. So I'm knocking off this 1 lakh IGST liability. Now I still have credit available of IGST. Now when I have to utilize it here, I have three options. Utilize more in CGST, option 1. Option 2, utilize more in SGST, or option 3, utilize in both. Now how to decide for that? You have to see the balance of the other two credits. Now since the balance of other two credits are equal, I will utilize the balance equally. 30, 30. So if I write a column here, balance, this balance has become nil. Now I have to utilize CGST. I can utilize it here, but the balance is 0. Already the entire IGST liability is nil, so nothing has to be utilized here. So whatever I have, I can utilize here. Again, SGST, I can utilize here, but there is no liability balance here. I cannot utilize here. This amount will be entirely utilized here. So the credit balances are nil, and the amount to be paid via cash ledger is this. I hope you all have the same answer, students. Yes, good. Good. Now let me go to the second scenario. So
Sir, I have a question.
Go ahead, beta.
For utilization of IGST ITC, do we have to split it equally, or can we do it on any ratio also?
Can we do it?
In any ratio as
Any
well?
ratio, any ratio.
Any ratio is fine. Yeah, okay.
Yes.
Okay, sir. Thank you.
So I take up the second scenario, 2 lakhs 150, 150 is my liability. Credit balances are nil, 190, 190. Nil. Now, this is 2. This was 1. Now, what is the rule, students? You have to start with IGST ITC first. Anyways, it is nil, so no question of knocking it off. Now you start with CGST. Now the rule is CGST has to be first utilized against CGST, so I'll utilize here. I cannot utilize against SGST. I still have balance 40 and I have liability in IGST, so I utilize here. So first here, then here. Correct? The balance is nil. Now I come to SGST credit. I cannot utilize here. I have to first utilize here. So I utilize here. And the balance I utilize here. Second. Against this is nil. And the amount paid through cash ledger. This is nil, this is nil, and this is 120. Right, students? Do you all have these answers? Second case. Okay. Very good. Very good. Chalo. Third case. So I output tax. Now in third scenario, what are my values? Liability is nil, 250, 250. Liability is nil, 250, 250. And ITC balances 150, 2 lakhs, 2 lakhs. Fine. Now, as a rule, I have to start utilizing IGST credit first, which has to be utilized here, but there is no liability. Now I can utilize it between both. Now, how to decide? For that, you see the credits of the other two. The other two credits are equal. So here I am dividing it equally. Now I'll start with CGST. I can utilize here, but the liability is not there. I have 2 lakhs credit. However, the liability which I have to now set off is only 175. I cannot utilize here. So 25,000 will be my balance carried down. Same thing I can utilize here, but there is no liability. I cannot utilize here. Out of 2 lakhs, I have to only now pay 175 because 75 is already paid. So again, 25,000 is my balance, and amount payable through cash ledger is nil. Correct? Case 3. Good. Very good. Now case 4. Two, three. And credits are 3, 2.5, 1.2. 3, 2.5. Now this is going to be interesting. See, Pawan, whether system picks it automatically, you are given the option to manually change it. So you will change it as per the best option which is suitable to you. Now I first utilize it here because that is compulsory. Now the balance 1 lakh. Now as you can see, I have more of CGST and less of SGST. Now since I have less of SGST, I should use this here because I have less balance in SGST. I can use it here, but I will use it entirely for SGST and nothing for CGST. Correct? So my entire now IGST credit is 0. Now I start with CGST. I can use here, but there is no balance. This I will use here. This I cannot use. Balance is nil. I can use here, but there is no balance. I cannot use here. Out of 3 lakhs, 1 lakh is utilized. So balance 120 I will utilize here. So amount payable through cash ledger 50, 80. Understood, students? Perfect. Now coming to the next scenario.
Hello, sir.
Yes.
Hello.
Yes, tell me.
Sir, in this fourth case, yes, sir, fourth case, I have utilized IGST of balance 1 lakh is equally to CGST and CGST and SGST. So the balance paying through cash ledger is SGST is 1,30,000. This answer is correct or wrong, sir?
It is
we can
correct,
u-
not a
we
problem.
can utilize. Okay.
See, it is not wrong so far as your and my total amount of cash ledger is same.
Yes,
But
sir.
it may happen that your and my cash ledger amount is different, then it can be a challenge. So
Okay,
total,
sir.
how much
But
you are paying through cash ledger?
1,30,000 in SGST.
SGST or CGST?
SGST, sir. I'm equally utilized IGST in CGST and SGST. Balance 1 lakh, sir. 50,000 and 50,000.
Okay, no problem. But this approach may not be correct always. That you will realize once we go to more examples, right?
Yes, sir.
So
But in
here, see,
exam,
you will get, in this case, you will get full marks because the amount payable by cash ledger is same. I am also paying 130, you are also paying 130, correct?
yes, sir.
So it is okay. But if this change, then your answer may be wrong.
Okay, sir. The total is matching, so it is not matter. So if the
Correct,
total is not matching, the answer is wrong.
correct.
So if that the total is not matching, I need to use you as per your calculations, sir. Correct?
Yes, obviously, beta.
Okay, sir. Understood.
Okay, now I'm using it here. Now here I have less in CGST and more in SGST. So I can utilize the balance 2 lakhs. But interestingly, if I utilize the balance 2 lakhs here, there can be a problem because I have CGST balance of 120. So if let us say I utilize this CGST balance of 120, how much is payable here? 130. So I will not utilize entire 2 lakhs because utilizing entire 2 lakhs will be wasting. So I will utilize 130 only here. So balance what is left for this is 70. Correct? So here CGST was less. So I have to utilize IGST for CGST first. But how much IGST I should utilize? For this, I first also checked how much CGST balance I am having. So I'm having CGST balance of 120. So I utilize only 130 over here because if I would have utilized entire 2 lakhs over here, then I would have balance of this CGST with me. So those who have utilized it in a different manner, you will get a balance. Now see how I will get the answer. Now my amount payable through cash ledger is 0. Now if you are getting amount payable through cash ledger in any of the columns, then it is unnecessarily paying cash, which is not good sign for the business.
Yes, sir. In this case, I got wrong answer, sir.
That is where I said you will get a wrong answer in a different scenario. Luckily, your answer was right in the previous scenario, but in this type of scenario, it will be wrong. So you
Yes,
have to
sir.
first see the other two balance and accordingly, you have to decide how to utilize IGST. So this will come
Yes, sir.
with practice more.
Okay, so when we utilize the ITC, we need to concentrate both output liability and ITC, both. Correct, sir?
Obviously, better. So you should utilize it in such a manner. See, the simple answer is you should utilize it in such a manner that you should get minimum amount payable in cash ledger.
Okay. Yes, understood.
Yes, Aditya.
Sir, sir, in third scenario, third case, balance is 25,000, $25,000, so, but total is 50,000, sir. Can we write as 50,000 in balance, sir? Not sir, amount payable for cash ledger in balance 50,000 can we rate or not, sir?
You can write, but see, that is not a problem because anyways, that is a balance column. So you can write it over there.
Okay, sir. Okay. Thank you, sir.
Yes. So students, I hope you understood this point. So this is what is about utilization of ITC. Which ITC has to be utilized against what? So see, the collective answer of section 49.5, 49A, 49B and rule 88A is this. So IGST should be utilized first. The ITC of IGST should be utilized first for IGST liability. Thereafter, it can be utilized for both in any order, in any proportion, but that I just showed you. That also you have to utilize by looking at the other two credits. Now, after you have utilized the IGST completely, which is the condition, ITC of IGST should be completely exhausted. This is compulsory. Then only you can proceed further. The next in sequence is CGST. CGST can be utilized against both, but the sequence first you should utilize for CGST, then if required for IGST. This is not allowed. And then last comes SGST, UTGST. This as a sequence you have to first utilize for SGST, then if required for IGST, it is not allowed to be utilized against CGST, right? So this is what is the sequence. Now see, you are having here some examples which you should refer to. Now we complete some more provisions. So the next point is some restrictions on utilizing your ITC. Now here the restriction is under 86A. Now what is this restriction saying? The restriction is saying that wherever the commissioner of an officer below the commissioner, but not below the rank of AC, has reasons to believe that you have taken your ITC fraudulently. So where they have some information on the basis of which they believe that you have taken your ITC fraudulently. In that case, they have power to put restrictions on your ITC. Now, what type of restrictions? They have power to block your ITC ledger. That is not allowing you to utilize any amount of ITC. This is also called as blocking of ITC ledger. So they can block your ITC ledger and this can be done up to a period of 1 year. So wherever they feel or they have that information that you have taken ITC fraudulently, then what is the power given to them under this rule 86A? The power is they will not allow you either refund of any unutilized amount or they will not allow you to utilize this ITC against discharging any liability. In short, they will block your ITC ledger so that you cannot utilize this ITC. Now the question is, on what grounds they will decide that you have availed ITC fraudulently? So that is also given. What are the circumstances of deciding that it is fraudulent? So ITC has been availed by you on the basis of tax invoice, etc., which is given to you by such type of a supplier who is non-existent. So the supplier itself is not in existence. If such a supplier has given you ITC, the ledger can be blocked by the commissioner or officer below him. Second reason is the supplier is existing, but the business is not existing. Now see both these points, how the officer will come to know. So they are doing some type of investigation. So they are visiting the supplier's premises. One, they don't find the supplier over there, so nobody is there. The premises are closed. Or the supplier is there, but there is no business going on. So one of the things is not existing. Either the supplier itself is not existing or the business over there is not existing. In one of these cases, if any of these happens, they will treat that you have taken the ITC fraudulently. and they can block your ITC ledger. Second, where they have information to believe that whatever ITC you have taken, against that you have not received any goods or service. It means it is a bogus ITC. There was no transaction at all. Hence, they have the power to block your credit ledger. And third, in respect of any supply, the tax in respect of which has not been paid. So where you have purchased the goods from a supplier who has defaulted in making payment of his or her tax. So these are the scenarios where the officer will treat your ITC as fraudulent. Further, now who is found non-existent? Here the supplier was non-existent. Here the buyer is not existent or is not conducting the business. So if you are found to be a bogus person, that is, you have taken a registration, but actually you are not there. So you have taken registration on a false address where you do not exist, or the address is there, but you are not running any business over there. Third, the registered person availing ITC is not in possession of the tax invoice. So basically, these are nothing but the section 16 conditions. If you find, if any of these conditions are not present, then the commissioner or the officer below him has the powers to block your ITC under Rule 86A. So 86A empowers them to block your ITC provided one of these things are present. One, firstly, from your supplier side, the supplier is not existing, the supplier's business is not being conducted, there is no actual receipt of good service, or the tax has not been paid to the government. All these are at the side of supplier. At your side, you are not existing, or your business is not being conducted, or you are not possessing the goods or services. You are not possessing the tax invoice. Now, if any of these things happen, they have the power to block your credit ledger up to 1 year. Blocking means you will now not be able to utilize the credit ledger to pay your tax or to get any refund. That is what is blocking of credit ledger. Now we come to the second restriction. Now this restriction is they have put a limit on the amount up to which you can use the credit ledger. Now interestingly, what is this limit? The limit is you can use your credit ledger only up to 99% of your tax liability. So let us say if your tax liability in a period is rupees 5 lakhs, you can utilize ITC up to maximum 99% of this. So 99% of this will come to, so 1% you cannot utilize. 1% you have to compulsorily pay through the cash ledger. So what is this second restriction? This I found very strange. I don't know what was their logic of bringing this restriction. So they want that at least 1% of your output tax liability you should pay in cash ledger, like how we solved the sums. In those sums, at many places, we got amount payable by cash ledger as nil. Now, if this restriction applies to you, you cannot do that. You have to compulsorily utilize or use cash ledger for making the payment. And how much you have to use? At least 1%. Now, when does this rule 86B applies? Now, this rule, which requires you to make minimum payment of 1% through cash ledger, is applicable whenever you are having a taxable supply in a month exceeding 50 lakhs, and this is before exempt or zero rated supply. That is, in other words, your taxable supply on which tax has to be paid, that supply in a month exceeds 50 lakhs. Second, Therefore, in cases where value of taxable supply in a month is up to 50 lakhs, the restriction would not be applicable. So this restriction will not apply where your supply in a month is up to 50 lakhs or below 50 lakhs. But where it is exceeding 50 lakhs, this restriction will apply. What restriction? That you have to pay minimum 1% through your cash ledger. Is this clear? Any questions with this point, students? Now, this rule has some relaxation. So firstly, when it is applicable, when your monthly turnover of taxable supplies exceeds 50 lakhs. In short, you are a big business. However, they have given some relaxation where despite of you being a big business, you will not be required to follow this restriction. In other words, you can fully utilize your credit ledger and there is no need of making payment of 1% in cash. Now, when this particular relaxation will be given, so they say that this restriction is not applicable. In other words, I'm using the word relaxation, where your income tax in a year is more than rupees 1 lakh. Now, which year? Of last both the two financial years. So your per year income tax liability in last two financial years is more than 1 lakh. Now this income tax should be of whom? Either of yourself or the Karta, or if you are HUF, the Karta, if you are company, the managing director, if you are a firm, then any of two partners, if you are a company, whole-time director, if you are any type of trust or something, then your members of the managing committee or your board of trustees. So when this restriction of making payment through cash ledger of minimum 1% will not apply when you are a big taxpayer in terms of income tax. In terms of income tax, what is big taxpayer? Where your income tax liability of 1 year exceeds rupees 1 lakh, and which year? Immediate preceding 2 years. The tax liability should be exceeding 1 lakh. Now, the second relaxation is to those persons who are claiming refund of more than rupees 1 lakh. Which refund? Input tax credit refund. So this is the refund of GST only. Now, when do you get this GST refund? Either where you are exporting your goods, which is called as zero rated supply, or you are under inverted duty structure. What is inverted duty structure? Your output rate is less, your input rate is more. So when you are falling in this second criteria, then also you are given relaxation of not making payment of tax, that 1% in cash. So second relaxation is if you are getting refund of more than rupees 1 lakh in a particular financial year. Which financial year? The preceding financial year. Now, payment of output tax liability using the cash ledger in excess of 1% of output in current financial year. If the registered person has discharged his output tax liability through electronic cash ledger of an amount in excess of 1%, and this has been done applied cumulatively up to the said month, that is the month for which you are now computing the liability in the current financial year, the restriction of 86B shall not apply. Now, what it means? So let us say you are presently computing liability of October 2025. Now, during this year, it means you have already paid liability from April to September. Now, what it says, if the registered person has discharged his output liability using the cash ledger of an amount in excess of 1% of the total output tax liability applied cumulatively up to the said month. In the current financial year, the restriction under 86B shall not apply. So it simply means whatever tax you have paid in this period is already exceeding 1% through the cash ledger, then you may not follow that restriction in October because you have already fulfilled that in the previous financial years. This exception provides relief to registered persons who have consistently made substantial cash payments toward their GST liabilities. The total cash payment of GST made by the registered person is considered cumulatively for all preceding months of the current financial year. The cumulative approach ensures that the registered person is given credit for its consistent cash payments throughout the year rather than assessing each month in isolation. So even if in your prior months you had this particular cash payment, then we will see cumulatively, and if cumulatively you have exceeded that 1% payment through cash, we will not make you make the payment in the current month. Now, it is pertinent to note that GST liability paid under RCM should not be taken into account. Why? Because anyways it is always required to be paid through cash ledger only. So while computing this 1% liability, you will not take into consideration the RCM liability. Now coming to the next part. Now there are some specified persons who are out of this rule 86B. That is, rule 86B is not applicable to them. Now the names will make it very obvious who are out and why they are out. So if the taxpayer is government department or the government's undertaking, which is PSU, or any local authority or any statutory body. So these people are outside this rule 86B. However, commissioner or an officer authorized by him in this behalf may remove the said restriction after such verifications as he deems fit. So this is rule 86B. Correct, students? So now after this, you have some computation questions. So this we are going to deal with in our next class. So till then, kindly come read, prepared with this whole chapter. Wherever you have doubts, I'll first clear your doubts in the next class. Today I did revision of the whole chapter. So now the whole chapter is thorough with you. Still, you prepare it at your end. Wherever you find there is any challenge, in the next class, we will discuss this and we will proceed with solving all these sums. So with this, I've concluded my topic today. We have completed the entire theory part with some practical understanding of the utilization part. Now in the next class, we will complete all the practical sums because this chapter is very important from practical perspective. So we'll look at this chapter from the practical angle in the next class. So till then, thank you very much. Keep studying and be in touch with all your subjects regularly. Thank you all. Good day. Bye. Good day. Good night. Bye-bye. Sir, session is over.